What's going on, guys? It's Brad with The Bottom Line. Today I want to talk about how you can make money from falling stock prices. Sorry I haven't posted a video in a minute. I've been crazy busy with work and school, but I promise it won't happen again. So if you feel that prices are overextended, there's a bear market or a recession coming, these are 4 different ways that you can profit. Before we get into things, if you would smash that like and subscribe button, I would very much appreciate it. And getting right into things here, the first is short selling. And this is very common and very simple, probably right next to inverse ETFs in terms of simplicity. But essentially with short selling, you are borrowing someone else's shares at a specific price. And when you do so, you have an obligation to return that number of shares to the lender. So you will get the shares, sell them off at the given price, and hope the price falls so you can buy the shares back at a cheaper price and keep the difference. So here's an example. Say we have stock Z at $10 per share. You're going to short one share at this price by borrowing the share and selling it for $10. The price then falls to $8. You buy the share back and give it to the lender, and you get to keep that $2. Congratulations. One thing to keep in mind with short selling, it can be very, very, very risky. Technically, you have unlimited loss potential, and you may be required to cover early, which usually doesn't happen. But basically, if you were in the red and you wanted to wait it out, the lender could say, hey, I want my shares back, and you would have to cover in the red. Here's a true story to show how dangerous short selling can be if you don't do it right. A man named Joe Campbell shorted a pharmaceutical company, KBIO, which was pretty much a penny stock at the time, for $33,000. And in one session, the price went up 800% and left him not only losing his $33,000, but with a negative balance of $106,000. So I think it goes without saying that you should be careful when you short sell. Okay, next, inverse ETFs. These are just ETFs that move opposite of their parent or mirror ETFs. So some are leveraged extra, meaning they'll move certain multiple times the parent ETF. Example here, SDS is a 2 times inverse ETF of the S&P 500. So if you expected the S&P to fall, say 1%, you would buy up this inverse ETF and it would move upwards 2%. Next, getting into options, we have put options. These can get a little complicated, so if they're confusing, don't worry, we will cover it more in future videos. But a put option is a contract to sell 100 shares of a stock at a specific price on a specific date. So typically when prices fall, you're going to see put option prices increase, not always due to things like timing and implied volatility, but generally that is what you will see. So example here, say we have a put option for stock ABC with a $30 strike by 4/31, and say that option selling for $100 and the stock ABC price is at $31. If you expected the price to fall all the way to $28, you would buy that option, that put option, for $100, and say at the end of the contract, 4/31, the price was $28. Well, the contract would then be worth $200, $100 more than you originally bought it, because you take the 100 shares and you multiply it by the $2 difference between 30 and 28. And that is your profit, $100 off the $100 you risk. Another option strategy, this is what I feel is one of the most awesome strategies in the market. This is good for if you still have a long-term positive outlook on the market and you want to keep your shares, but you expect prices to maybe stay neutral or fall in the short term. You can employ this strategy. So you're going to need 100 shares of the stock or ETF, whatever it is, and you are going to sell someone else the right to buy your shares at, say, the current price or a higher price. And that will all depend on how likely you want it to be that you lose your shares or not. If you really don't want to lose your shares, you would sell a contract far out of the money. And using this strategy will protect you from downside risk, but it will also cap your upside risk. So here's an example. Say we have 100 shares of XYZ and they are currently at $50 per share. If you expect the price to fall to $49 by the end of the month, but you want to keep your shares, you would sell a contract a month out with a strike price of $50 and you would receive a $100 credit. So, if you are right at the end of the month and the stock price is at $49, well, that option is now worthless because no one's going to buy the stock at $50 when it's now at $49. So, you're going to keep the full $100 credit and you get to keep your 100 shares, effectively lowering your cost average on your position. So, guys, that is all. Those are 4 ways that you can make money if you expect a down market, a recession, whatever it might be. Historically, your best bet will be on stock prices rising in the long term. But if you see short-term falling prices, whatever it might be, then you can use these strategies. Guys, if you enjoyed the video and found it useful, please smash that like and subscribe button. Comment below if you have any questions, if anything was confusing and you want me to cover it in future videos. Thanks for tuning in, and I will catch you guys in the next video.